Let us sit down together and look at the numbers that are quietly rewriting the rules of the global financial system tonight. The headlines are filled with a dizzying array of geopolitical flashpoints, from energy facility incidents to reports of aerial incursions. But when I look at these reports, I do not see political narratives. I see structural pressures that directly affect the cost of capital. The market often reacts to these headlines with erratic, emotional swings, but our role as investors is to remain entirely unemotional and look at the underlying math. We are witnessing a significant elevation in Treasury note yields, with the 10-year note climbing toward levels that increase the borrowing cost for every consumer and corporation in the country. When yields on risk-free government debt approach 5%, the entire landscape of equity valuation changes fundamentally. An asset that generates a modest return no longer looks attractive when you can secure a higher, safer yield simply by holding government bonds. This creates a natural mathematical downward pressure on riskier assets, forcing us to reevaluate our personal portfolios with extreme discipline. I remember when I first started tracking these macro shifts in my early 20s, I used to think I could navigate the volatility by trading the news. I thought I could identify a tactical advantage in every dip and surge, which was really just an illusion before the market taught me about the reality of risk. The truth is much more boring. It is simply about understanding historical patterns and staying completely patient when the crowd panics. We are looking at an environment where inflation remains sticky, hovering near 4%, while the cost of servicing national debt continues to expand. When interest payments become the fastest growing line item in a national budget, that economy enters a long, slow period of fiscal constriction. This does not mean we should rush to sell everything or hide in a bunker, but it does mean we should be extremely critical of our leverage levels if you are carrying variable interest debt in this environment. You are essentially paying a tax that compounds against your ability to build wealth. The most important action you can take right now is to clear your personal balance sheet of those structural leaks. Paying off high-interest liabilities provides a guaranteed risk-free return that is currently superior to almost any speculative investment. We must also look at the gold and energy markets, which are responding to these geopolitical stressors by pricing in a higher risk premium. But do not let the short-term price spikes trick you into chasing a momentum trade that has already been priced in by institutional participants. True wealth is not built by catching the absolute top or bottom of a volatile move. It is built by consistent, boring accumulation during the periods of stability. I want to talk about the concept of the weighing machine, which is how the market eventually filters out the noise. In the short term, the market is a voting machine, swayed by tweets, headlines, and fear. But over a 5 or 10-year horizon, the market functions as a weighing machine, measuring the actual cash flows and the fundamental productivity of the businesses you hold. When the macro environment gets loud, you should respond by getting even more focused on your long-term compounding plan if you are worried about the security of the dollar or the stability of the global currency regime. Focus your allocation on assets that hold intrinsic utility. This means maintaining a diversified basket of equities that have pricing power, along with a layer of precious metals to act as a hedge against systemic devaluation. But ensure that your exposure to these assets is sized correctly so that you can hold them through a significant correction without feeling the need to sell. I see so many people around our age making the mistake of overextending their positions because they feel like they are missing out on the action. They use high leverage to amplify their returns, but they fail to account for the fact that a leveraged position can be wiped out by a single bad day of volatility. If you lose 50% of your capital, you do not need a 50% gain to get back to even. You need a 100% gain. That is a mathematical trap that most people never recover from, and it is entirely avoidable through simple, prudent position sizing. Let us look at the upcoming calendar, specifically the policy discussions regarding interest rates and debt management. Do not view these events as a signal to open a new trade. View them as an opportunity to observe how the big institutional money is reallocating itself. The goal is to align your strategy with the long-term reality of the cycle, not to fight the current momentum of the headlines. Stay grounded in your research, keep your personal expenses as low as possible, and maintain a high level of liquidity. Having cash on the sidelines is not a failure to invest. It is the highest form of strategic patience. It gives you the optionality to deploy capital when a premier asset hits a valuation that makes mathematical sense. You are playing a game of decades, not a game of days, and the winners are the ones who stay in the game the longest. Take this evening to audit your own investment policy statement, verify that your holdings align with your true time horizon, and ignore the noise of the nightly news cycle. The math will always be there, and the market will always offer you another chance to grow, provided you protect the capital you have already earned. I know the news feels like a constant barrage of crises lately, and it is easy to feel like the floor is falling out from under us. But when I look at the charts, I do not see a reason to panic. I see a reminder of why we must stick to our process. I remember back in 2020 when I was just finishing my degree, I thought that understanding the economy was about predicting the next big swing. I spent hours staring at green and red candles, convinced that if I could just identify the perfect entry point, I would be set for life. I was wrong. And I think it is important to admit that I was often completely delusional. I thought I was a genius, but in reality, I was just a young person with a bit of luck and a complete lack of perspective. The market has a way of humbling us, and those early mistakes were the most expensive tuition I ever paid. Now that I have my first $100,000 put away, I look at the world very differently. I do not care about the latest hot stock or the newest crypto craze or the political drama that dominates the front page. I care about the math, the boring, predictable, inevitable math of compounding that works whether we are paying attention or not. Let us look at the current state of interest rates, which seem to be the only thing anyone is talking about. When the central bank keeps rates higher for longer, it is essentially sending a signal to the entire global economy. It is saying that the era of free money is over and that capital now has a cost that we must respect. For a long time, we lived in a world where you could throw money at anything and watch it grow because interest rates were effectively zero. But that was a distortion, not a reality. And now we are living through the correction. It is uncomfortable, it is frustrating, and for many businesses, it is painful. But for a long-term investor, it is a healthy reset. When you can get a decent return on a risk-free asset, you stop feeling the pressure to gamble on speculative garbage that gives you the freedom to sit on your hands to keep your powder dry and to wait for real value to emerge. I know that sounds incredibly unglamorous, especially when you see people online bragging about their overnight gains, but I want you to remember that those people are playing a different game than we are. They are playing the game of luck, and luck is not a sustainable strategy. We are playing the game of survival. And survival is the only way to reach the finish line. Let us talk about inflation, because it is eating away at our purchasing power while we sit here and worry about it. Inflation is not a monster that can be killed with a single policy change. It is a structural reality of the system we live in. The only way to win against inflation is to own assets that produce more than the rate of erosion. That is why I spend so much time talking about index funds and solid businesses. You do not need to pick the winner of the next tech boom. You just need to own the companies that provide value every single day. Think about the companies you use every morning, the ones that make the software you rely on or the goods you purchase at the store. Those companies are still making money, even when the market is red, even when the news is bad. That is where the growth comes from. It comes from human productivity, not from market sentiment. I see a lot of my peers obsessing over the price of gold or the latest move in crypto. And while there is nothing wrong with having a small allocation to those things, they should not be the foundation of your portfolio. If you are looking for a magic bullet, you are already lost. The magic is in the monotony. It is in the act of investing $500 every 2 weeks, month after month, year after year. It is in the discipline of saying no to the shiny new car so you can put that money into your index funds instead. It is in the boring life that allows you to be free later. I was 21 when I started this journey, and I remember how hard it was to stay the course when my friends were going on expensive trips and living for the moment. I felt like I was missing out on the best years of my life. But then I realized that the best years are the ones where you have the freedom to choose what you do. That freedom is what $100,000 buys you. It is not about buying stuff. It is about buying the ability to say no to things you do not want to do. We are living in an era where everyone is trying to sell us something, whether it is a course on how to trade, or a newsletter, or a subscription. I want you to be very careful with where you put your trust. Most of the people shouting about wealth are just trying to get rich off your desire to get rich. The truth is that building wealth is slow, it is quiet, and it is entirely untelevised. There is no camera crew following me when I move money into my brokerage account. There is no cheering crowd when I hit a milestone. It is just me, my spreadsheet, and the knowledge that I am building a future that belongs to me. Let us think about the geopolitical landscape for a moment and how it impacts our capital. We see the headlines about tensions and the shifting alliances between major powers. It is natural to feel anxious when we read about these things, but as investors, we have to compartmentalize. The world has always been a dangerous place, and the markets have always found a way to continue moving forward. You cannot let your investment thesis be dictated by the daily news cycle. Because the news is designed to keep you in a state of high alert. When you are in a state of high alert, you make emotional decisions. And emotional decisions are the enemy of wealth. My rule of thumb is to look at the world through a 10-year lens. If I look at the current problem today, will it matter in 10 years? If the answer is no, I ignore it. If the answer is yes, I factor it into my long-term risk management, but I do not let it stop me from executing my plan. This perspective has saved me from selling my positions during every major correction I have seen in the last few years, and believe me, there have been plenty of moments where I felt like selling everything. I remember a Tuesday morning in 2022 when the market was down by a significant percentage and I felt a physical ache in my chest. I wanted to sell, I wanted to lock in my losses and just get out, but I looked at my spreadsheet, I looked at my long-term goals, and I realized that selling would be a betrayal of the person I wanted to be, so I did nothing. I went for a walk, I drank a cup of coffee, and I let the market do what it does best, which is recover over time. That was the most profitable decision I made that entire year. Because it was a decision to do nothing. Doing nothing is an active choice. It is a choice to trust your thesis and let time work its magic. We need to talk about debt because it is the silent killer of financial freedom. I am not just talking about credit cards. I am talking about any form of debt that you do not need. The interest rate on consumer debt is a direct transfer of wealth from you to the bank. Why would you want to work for the bank? I make it a priority to stay out of debt, not because I am a minimalist, but because I am a pragmatist. Every dollar I pay in interest is a dollar that could have been earning interest for me. The math of debt is simple. You are either the one paying interest or you are the one earning it. Be the one who earns it. It starts with small decisions like not buying things you cannot afford with cash. It continues with big decisions like being careful about how much house you buy or what kind of lifestyle you sustain. I know it is hard. I know the pressure to keep up with everyone else is intense. But you are not competing with everyone else. You are only competing with your past self if you are doing better today than you were last year. You are winning. The key is consistency, not intensity. You do not need to be a hero for 1 month. You need to be a disciplined person for 10 years. Let us discuss the concept of the $100,000 milestone, because it is a significant psychological hurdle. When you have your first 100,000, the compound interest begins to do some of the heavy lifting for you. It is not enough to retire on, but it is enough to show you that the system works. It is the point where you stop working for your money and start letting your money work for you. Once you get there, the next 100,000 comes much faster. That is the power of the curve. It starts flat and then it suddenly goes vertical, but you have to endure the flat part. That is the test. Most people quit in the flat part because they do not see the results yet. They think it is not working, so they abandon their strategy and go look for something else. Do not be that person. Stay in the flat part. Keep adding, keep saving, keep learning. The vertical part will come, but you have to earn it. I want to be clear that I do not know what the market will do tomorrow. Nobody knows. And anyone who tells you they do is either lying or trying to sell you something. The market is a chaotic system influenced by millions of people making millions of decisions trying to predict it. It's like trying to predict the weather in a hurricane instead of trying to predict the weather. Build a house that can withstand the wind. That house is your portfolio, your emergency fund, and your commitment to your own financial education. If you have a solid foundation, you do not need to worry about the storm. You can sit back, drink your coffee, and wait for the sun to come back out, because it always does. Think about the historical data. Look at how the market has performed over the last 100 years. Despite wars, depressions, pandemics, and every other crisis you can imagine, the trend has been consistently upward. That trend is a reflection of the human spirit, the drive to create, to build, and to improve. As long as people have the desire to solve problems and create value, the market will continue to grow. You want to own a piece of that growth. You want to be a participant in the economy, not just an observer. That is why I'm such a big fan of broad market index funds. They allow you to own a little bit of everything, so you are not betting on a single company. You are betting on the entire engine of human progress. It is the most efficient, the most reliable, and the most boring way to build wealth. And that is exactly why it works. I feel like we spend too much time listening to the wrong people. We listen to the influencers who tell us how to get rich quick. We listen to the news anchors who tell us the world is ending. We listen to our friends who are making mistakes. We need to curate our inputs. We need to read books that have stood the test of time. We need to talk to people who have achieved the things we want to achieve. We need to focus on our own internal growth. Wealth is not just about the numbers on the screen. It is about the person you become while you are building it. It is about the patience, the resilience, the self-control, and the wisdom you acquire. These are qualities that will serve you in every area of your life. Not just in your finances, they are the real return on investment. I know I keep coming back to the same theme of discipline, but that is because it is the only thing that matters. Without discipline, you can have all the knowledge in the world and still end up broke. With discipline, you can start from nothing and end up wealthy. It is not about being talented. It is about being consistent. It is about showing up every day and doing the work, even when you do not feel like it, even when you are tired, even when you are discouraged, even when you are tempted to do something else. That is the definition of character. I think that is what being 26 is really about. It is about realizing that your life is a project and you are the project manager. You get to decide what the goals are. You get to decide how to allocate your resources, and you get to decide how to respond to the challenges. Nobody is going to do this for you. Your parents are not going to do it for you. The government is not going to do it for you. Your employer is not going to do it for you. It is entirely on you. And that is the best news, because it means you have the power to change your life. It means you are the architect of your own future. So take that responsibility seriously. Build a plan that makes sense, stick to it with everything you have, and trust that the results will follow. They always do. I want to mention something about the fear of missing out, or what people call FOMO. It is one of the most destructive forces in your investment journey. You see a stock go up and you feel like you are losing out, but you are not losing out on anything. Because you are not participating in a lottery. You are participating in a long-term compounding game. Every time you chase a gain, you are taking a risk that is not justified by your analysis. You are abandoning your strategy for a moment of validation. And usually that validation is short-lived. The market will eventually correct. And those who chase the gain will be left holding the bag. Stay in your lane, focus on your own progress, celebrate your small wins, and learn from your mistakes. Do not compare yourself to others, because you do not know their story. You do not know how much risk they are taking. You do not know what their goals are. You do not know what their financial situation is. Your only job is to be better than you were yesterday. That is the only comparison that matters. Let us take a step back and look at the big picture of your life. What are you actually building toward? Is it just a number in a bank account, or is it a specific kind of life? I hope it is the latter, because if all you have is money, you are not actually wealthy. True wealth is about the freedom to spend your time the way you want. It is about the relationships you have, the health you maintain, and the purpose you pursue. Use your money as a tool to facilitate those things. Do not let your money become your master. I have met people who have millions of dollars and are completely miserable. They are slaves to their portfolios. They are obsessed with the market, and they have lost the ability to enjoy the simple things. That is not the kind of wealth I am interested in. I am interested in a wealth that gives me the peace of mind to enjoy a quiet afternoon, a good book, and a great conversation. That is why I preach the gospel of the boring. Because the boring life is the life that allows you to be free. It allows you to focus on what matters instead of being distracted by what does not. As we look forward to the next few years, I think the most important trait we can cultivate is adaptability. The world is changing fast, and the tools we use today might be different tomorrow. Stay curious, keep learning, and keep updating your mental models, but do not change your principles. The principles of saving, investing, and staying out of debt are timeless. They worked 100 years ago, they work today, and they will work 100 years from now. Hold on to those. Everything else is just noise. I hope this conversation has been helpful for you. I hope it has given you a sense of perspective and a bit of encouragement. Building wealth is a lonely road, and it is nice to know that there are other people walking it alongside you. We are all just trying to figure it out. We are all just trying to build something that lasts. Do not be so hard on yourself. You are doing better than you think you are. Just keep showing up, keep learning, and keep pushing forward. And remember that it is not a race. It is a marathon, and the most important thing is that you finish it. Let us consider the nature of compound interest as the eighth wonder of the world. It is not flashy. It is not an overnight success. It is slow and steady. When you start with $10 and you add to it every week, you do not see the difference for a long time. But after 5 years, something shifts. The curve begins to bend upward. Not because you are doing more, but because the math has taken over. That is the moment of truth for an investor. Will you pull your money out because you feel the urge to spend, or will you let it sit and work? If you let it sit, you win. It is that simple, and it is that difficult. Most of the challenges we face are not about the market. They are about our own psychology. We are hardwired to want rewards immediately, but wealth is a delayed gratification game. When you feel that urge to check your portfolio, walk away from the screen. When you feel the urge to trade, do something else. The market will continue to function without your input, and in fact, it will probably function better without it. I have found that the less I touch my investments, the better they perform. It is the paradox of active management. The more you try to control, the less control you actually have. True control comes from having a plan and sticking to it. No matter what happens, even in times of severe market stress, you should have your plan written down so you do not have to think in the heat of the moment if you have a plan. You have a compass. When you get lost in the noise, look at your compass. It will guide you back to your path. It will remind you why you started, and it will give you the confidence to continue. We are all building something, whether it is a small portfolio or a large empire. The principles are the same. Be prudent, be patient, and be persistent. If you do these three things, you will succeed. There is no doubt in my mind about that. The math is on your side, the history is on your side, and the logic is on your side. So just keep going. The journey is long, but it is worth it. Everything you are doing today is building the foundation for your future. Take pride in your discipline, take pride in your patience, and take pride in your refusal to participate in the madness of the crowd. You are setting yourself apart. You are building a life that is truly your own. That is the